Welcome to vTalkInsight, Risk Sentiment Daily for April 1st, 2026. After one of the most volatile months in years, a powerful late-month equity rebound is colliding with an unresolved Middle East energy shock. Let us unpack what this fragile risk-on tone really rests on right now. Across assets, today's picture looks like a fragile risk-on rebound rather than a clean regime change. Global equities just staged a broad-based rally, with the S&P 500 jumping close to 3% on the final trading day of the month and 9 of 11 sectors advancing. That bounce comes after one of the worst monthly drawdowns in years, with global benchmarks erasing most of their year-to-date gains and the S&P still lower for both the month and the year despite the late surge. Volatility remains elevated even as it has eased off the recent peaks, reflecting a market that wants to add risk but still respects the underlying shocks. The rebound has been led by cyclically exposed areas, including airlines and consumer-facing sectors, while traditional defensives have lagged. Compared with the firmly defensive tone described just a day ago, this shift signals greater willingness to look through near-term headlines, but it is happening against the backdrop of thinner holiday week liquidity and a very unstable energy backdrop. Outside equities, the message is more cautious. The US dollar is enjoying its strongest month in years on haven demand. Oil remains above $80 a barrel after a record monthly rally, and credit investors are quietly positioning for wider spreads. Put together, sentiment today is best framed as fragile risk-on. Price action is constructive, but it is built on narrow foundations and remains highly sensitive to geopolitical and energy headlines. De-escalation hopes in the Middle East are the single biggest bullish driver behind today's risk tone. Equities have surged on reports that the United States may end its military campaign against Iran and on signals from Tehran that it is open to ending the conflict. U.S. stocks rallied around 3% with broad participation across sectors and airline shares, which are acutely sensitive to jet fuel costs and travel demand, jumped close to 6% on the day. Price action in energy-sensitive assets suggests markets are starting to price a potential off-ramp rather than a prolonged escalation. Despite fresh attacks on tankers and infrastructure near the Strait of Hormuz, spot oil prices have sometimes reacted only modestly, indicating that investors are focusing more on the odds of restored flows than on each individual headline. Some commentary even notes that markets appear to be assuming an eventual settlement that stops short of granting Iran control over shipping lanes or tolls, even though regional governments remain fiercely opposed to that outcome. Options and flow data point to a blend of optimism and skepticism. Investors have been quick to take profits on the latest equity rally, fading large moves in both directions and monetizing hedges after sell-offs. That mean reversion mindset tells us that while de-escalation hopes are driving sharp intraday moves, many institutional players still see this as trading around a high volatility range rather than the start of a durable bull market. The counterpoint is that policy messaging remains confused. Conflicting signals from Washington on whether military withdrawal is tied to reopening the strait and what a final settlement might look like keep geopolitical risk premia elevated. Any renewed escalation, such as more disruptive strikes near energy infrastructure or hardened negotiating positions, could quickly unwind the current optimism and hit the very sectors that have just bounced, including travel and cyclicals. For now, the takeaway is that de-escalation hopes in the Middle East are powering a powerful relief rally, but the trade is strictly headline-driven. Markets will be watching for clarity on U.S. timelines, security of tanker routes, and any concrete roadmap for reopening key choke points. Until those pieces fall into place, risk sentiment will remain highly reactive to every statement and incident in the region. U.S. earnings resilience and growth expectations form a second key support for risk appetite. Despite a sharp correction in equity prices, corporate results have generally been solid, with many companies continuing to beat estimates and earnings forecasts for the S&P 500 being revised higher. Some strategists have responded by raising both index targets and earnings projections, citing stronger than expected profit momentum and a U.S. economy that has, so far, absorbed the energy shock better than many feared. Relative to other regions, the U.S. equity market is viewed as a comparative safe harbor. Positioning is described as light, earnings revisions are positive, and the domestic economy is seen as less exposed to higher oil prices than Europe or large parts of Asia. That combination underpins views that U.S. equities could outperform global peers during the crisis, and that downside risk is more limited if growth and earnings hold near current expectations. However, this cushion is not without risk. Valuations for major technology names have compressed from very elevated levels but still sit above historical averages, while consensus is looking for roughly mid-teens earnings growth this year and next. That leaves little room for disappointment. A weaker consumer, higher input costs, or more cautious corporate guidance in the coming earnings season could all trigger fresh volatility if those optimistic forecasts are revised down. The practical implication is that earnings season becomes a major sentiment catalyst. If companies can reaffirm or even lift guidance in the face of geopolitical stress and higher energy bills, the narrative of U.S. resilience will strengthen. If not, the current rebound could give way to renewed derating, especially in sectors where expectations are still high and pricing power looks more limited. The third bullish driver is the AI adoption and investment tailwind, which continues to reshape medium-term equity narratives. Major institutions see rapid AI uptake as a genuine inflection point, with benefits extending well beyond the technology sector into industrials, utilities, materials, and financials. That vision of higher productivity and new business models provides an important counterweight to cyclical worries, helping some investors stay engaged with risk assets even as macro volatility spikes. Recent deal flow illustrates the scale of this theme. NVIDIA's multi-billion-dollar investment in Marvel and their collaboration on advanced networking technologies sent both stocks sharply higher, underlining how chipmakers tied to AI infrastructure remain in demand. In private markets, huge funding rounds for leading AI developers highlight the intense competition to build and train ever larger models, drawing substantial capital into the broader AI ecosystem. At the same time, the AI story brings its own sources of volatility. Tech and AI-related equity volatility has compressed relative to broader macro moves as investors refocus on energy and policy risks, and some software valuations are already under pressure from concerns about disruption and pricing. There are also worries that rapid AI-enabled productivity gains could translate into large-scale job losses, which would eventually spill over into consumer demand, retirement savings flows, and credit quality. For risk sentiment, the net effect is that AI adoption and investment provide a medium-term support rather than a near-term hedge. The theme helps justify staying engaged in selected growth areas, but it does not fully offset the macro shock coming from energy and geopolitics. How AI-exposed sectors trade through the next leg of the earnings cycle will be an important signal of whether this structural tailwind can keep overpowering shorter-term headwinds. Turning to the bearish side, the Middle East energy shock and shortages remain the dominant macro risk overshadowing today's rally. A major disruption around the Strait of Hormuz has left roughly 20 million barrels per day effectively stranded, with tankers facing heightened security threats and soaring insurance costs. Brent crude has recorded its largest monthly gain on record, rising more than 50% and pushing benchmark prices well above $100 a barrel. Crucially, the stress is not just in futures curves, it is now visible in the physical market. Refiners in several regions are struggling to secure crude, with acute shortages emerging in jet fuel and diesel, and some Asian and European markets already feeling supply squeezes. In the United Kingdom, jet fuel shortages are described as imminent, with the last scheduled shipment about to arrive and no replacement cargoes yet lined up. Global inventories and strategic reserves offer only a thin buffer. Onshore and offshore stocks provide roughly a month of cover, but without restored flows, shortages in major consuming regions could intensify soon after. Even if the conflict de-escalates quickly, delivery times mean it could take 4 to 6 weeks for crude to reach refiners in volume, keeping upward pressure on refined product prices. Scenario analysis from market participants sketches some uncomfortable paths. With inventories low and key choke points at risk, Brent prices are projected to average around $125 with potential spikes toward $150 if disruptions persist. In a more severe scenario, such as a 2-week closure of critical shipping lanes or conflict stretching into early summer, crude prices could reach levels near $200, with obvious implications for global growth and market stability. In options markets, upside call premiums on oil remain unusually rich relative to puts, a pattern historically associated with prolonged periods of elevated prices. This underscores that, beneath the day-to-day equity swings, the energy shock is still anchoring the macro narrative. For risk sentiment, it acts as a ceiling. Rallies can occur on de-escalation hopes, but as long as physical shortages and supply risks persist, they are likely to remain vulnerable. The second major headwind is rising stagflation and growth shock risk, especially for energy importing regions. Persistently high oil prices are expected to slow U.S. growth to below 2% and push Europe toward flat or even negative growth. At the same time, inflation data are re-accelerating. Euro area inflation has jumped, with readings in March marking the highest level in well over a year, largely driven by energy costs linked to the conflict. Households are feeling the strain. U.S. gasoline prices have leapt from just under $3 to around $4 per gallon within a month, amplifying cost of living pressures in an election year. Analysts highlight a bifurcated consumer, where the top 40% of households still have credit capacity, while the bottom 60% are largely living paycheck to paycheck and facing persistent food and energy inflation. Central banks face an uncomfortable trade-off. Bond markets are shifting focus from inflation to growth risks, with some yields pulling back as investors seek safety, yet rate markets in places like the UK still price further hikes despite signs of consumer and labor market weakness. In the United States, the Federal Reserve is signaling a higher-for-longer stance, with little appetite for cuts while inflation remains above target and the labor market, though softening, is not yet weak. Some observers argue that markets are too focused on inflation and not focused enough on the potential growth shock, particularly for Europe and Asia, which are more exposed to energy imports. Rising energy shortages could soon force governments to restrict mobility and energy use, weighing on activity within weeks. This mix of weaker growth, still high inflation, and constrained policy room is a classic stagflation backdrop, and it limits how far risk sentiment can recover on geopolitical headlines alone. The third bearish driver is elevated equity and credit stress that has built up beneath the surface. Global equities have just endured their worst monthly losses since major crises, with nearly $12 trillion of market value erased across major benchmarks. The S&P 500 has suffered its weakest start to a year since the early 2000s, with only a handful of positive weeks, and indices in Japan and South Korea have logged their worst months since 2008. Technology leadership has cracked. Major U.S. tech names, along with semiconductors and memory chip stocks, have experienced deep drawdowns, and big tech is no longer viewed as a defensive haven in this environment. Forward valuation multiples have fallen from the mid-20s to the high teens, but they still sit above long-term averages, while earnings expectations for the index remain ambitious, raising the risk of further derating if growth slows. What makes this phase particularly uncomfortable is that traditional safe havens have not provided reliable protection. Gold, silver, and government bonds have struggled to offset equity losses over the quarter, leaving investors with fewer obvious defensive tools. Energy has been one of the few areas of relative safety, but the strength of that trade to date suggests latecomers may now be facing less favorable risk-reward. In credit, investors are increasingly positioning for stress rather than systemic crisis. Credit spreads are expected to widen further, and put options on high-yield and investment-grade credit ETFs are seen as relatively inexpensive ways to express that view. There are also concerns that liquidity mismatches in these vehicles could amplify downside moves during a shock as ETF prices gap while the underlying bonds become harder to trade. All of this means that, Even after the latest equity rebound, sentiment remains fragile. Options flows show investors fading big moves rather than chasing them, and the lack of clear safe havens increases the premium on careful risk sizing and diversification. Any disappointment on growth, earnings, or geopolitics could quickly reactivate the stress that has already surfaced in both equity and credit markets. To sum up, today's backdrop is a fragile risk on recovery, de-escalation hopes in the Middle East, resilient U.S. earnings, and a powerful AI investment wave are encouraging investors to put some risk back on, even as an unresolved energy shock, rising stagflation fears, and persistent equity and credit stress continue to cap the upside. Going forward, the balance of risks will hinge on how quickly oil flows normalize, how inflation and growth data evolve in Europe and the United States, and whether the coming earnings season can validate still optimistic profit expectations. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.